markets are pulling back as rates rise, while investors are worried about the Fed's response to all the strong economic data that's been coming out with jobs, CPI, PPI, all of the things that the Fed wants to keep under control, and the loosening of financial conditions. Even though the Fed said financial conditions had tightened somewhat, the markets were still running pretty hot. And right now, today, they're down. Dow is down 1.86%, S&P down 1.81%, NASDAQ down 2.2%. So the question is this a new reversal in the markets or just a little bit of a pullback because conditions were a bit overheated? And it could just be that, as the Fed is not meeting until March 20th, 21st, something like that. So we're going to get another CPI report. But right now, the markets are starting to price in the potential for a 50 basis point rate hike, because a couple of Fed members came out and said that with inflation rising again, going for that double peak, and basically, they missed their projections in terms of inflation the first time. So the markets are worried that they might be missing their projection on inflation this time, and the Fed's going to have to come out and really get after the market with rate hikes, which will again increase the risks of a full-blown recession. So that's what the markets are pricing in right now. And of course, the pain trade also was higher. So this could be a broader pullback with that pain trade in mind. And we'll look at that in just a minute. You got to remember, the markets are designed to extract the most amount of value, the most amount of money from the most amount of people. How do you do that? You pump the markets up, get everybody really bullish, and then you pull the rug out from under them and liquidate everyone. So basically, right now, the benchmark 10-year Treasury yield is climbing to 3.9%, while the 2-year rate advanced to 4.7%. These are levels not seen since November, but the market does seem composed despite the fact that it's going lower at the current moment. This is just the way some investors get ahead of themselves. There is some emotion in the market, but this downdraft is going to be bought. So that buy the dip mentality is still out there, and that's what the Fed is trying to decondition in the markets, is the buy the dip mentality. But as you can see, markets kind of reversing here, breaking this level, but still hasn't reached these lower levels. I mean, this is your last line here that you're looking for on the markets for the Dow, right in this area. As long as it stays above that, it's just consolidation. NASDAQ, same thing, kind of working this level of support right here at the moment. And then S&P has broken this upper range and now working at this level right here for the next stop. And these are kind of lines in the sand for the markets that if they break below, then they could start revisiting some of these broader lows. And of course, some of the lows we're talking about were back in the December timeframe. Then you have the October timeframe. The Dow has been well above that October low, whereas the NASDAQ and S&P have been somewhat above, but not as far as the Dow. So, likely to see a revisiting of these December lows. Unless something really bad happens, then you could have a potential to run down and retest those October lows. But right now, not a whole lot of real panic out there, just markets pricing in the chances of a 50 basis point rate hike, trying to keep a bottom in. And again, a lot of capital out there that needs to be invested. That's kind of what's keeping the markets up. Here's the VIX popping up. As we said, when the VIX is low, that 17, 18 range, you can expect it to pop up into that, 20 to 30, 35 range. That puts you back in your October low range. If it gets up in here, the December range is right up in here in the 25. So it's heading for that December range, where if it breaks past that, then you can start to look for that 30, 35 range. And that's where you're back to those October lows versus this December lows. The Dixie making a little bit of a run here. Question is, is it going to exhaust and roll back over? This puts pressure on Bitcoin and risk assets. Then the 10-year on the move again, have a W formation here. So it looks like the potential for this to kind of continue on up here and retest this range right there at the 4.3, almost 4.4 level, which was set again back in October. So the table is being set for these indexes to potentially start testing these October lows again. What does that mean for Bitcoin? So the interesting thing about Bitcoin is a lot of the indicators, a lot of the charts are showing that the bottom is in. Of course, these are all moving averages. So, a lot of the indicators like the, hash ribbon indicator flash to buy signal, we can take a look at some of those things. Let's go ahead and take a look at the hash ribbon right here on Bitcoin. Let's see, hash ribbon. We'll take a look at the Bitcoin hash ribbon right here. So we had that buy signal back here in January. So usually when that happens, Bitcoin generally does not come back down below that level, although it did the last time over here and it did the last time over here. So that's been invalidated a couple of times. So this is just, again, these are based on averages. So, as price moves up, these averages are going to flash. So that's the Bitcoin hash ribbon indicator. Let's take a look at the Gaussian channel. Right now, when you look at the Gaussian channel on Bitcoin, what's going on here? Got to spell Gaussian. There we go. Gaussian channel on Bitcoin. If you look at it on the daily, we got a nice little buy right here. It's mainly been in the red and a downtrend on the daily. You occasionally get these green areas here where it can pop up, but the weekly is what I'm really looking at. And right now, it's rejecting on the lower level. It rejected on the lower level of the weekly and is currently above that lower band. And generally, once it breaks in there, it can continue up to test this mid-level like it did right back in this area here in 2019. It rejected here and then kind of wrestled with it there, found support on that lower level, and then worked its way up from there, and eventually rolling over and retesting, potentially that low area. So that's what happened in 2019, kind of looking like a similar thing here in 2023. So that's on the weekly. And then again, if we look at the moving averages, still rejecting on the 200-week moving average. And until Bitcoin gets back above the 200-week moving average, it's just not a good sign for Bitcoin right now, still finding a rejection, but it could continue to kind of hang in this range and just range in here, go back down, check that $15,000 level, and continue to range in there for a while it carves a broader base in. But a lot of the indicators are showing that the bottom is in, not necessarily a reversal to bull market, but that this 15,000 could be a low range that holds for this macro cycle if nothing else catastrophic happens in the markets and we just have general Fed fund rates raising. That 15,000 level could hang on for Bitcoin and be somewhat of a longer term bottom. And I do believe that the probabilities are pretty high that Bitcoin's going to roll over, check that level. And of course, if that holds, then that could be a nice consolidation area, a nice area for Bitcoin to put a good base in for the longer term. But this is not bull market. Again, a lot of this was just manipulation, liquidations, things like that, kind of propping price up and keeping it up. And again, what's the pain trade? The pain trade when we were over here, I said was higher, up to that 25,000 level where you get a bunch of people sucked in, you distribute up here, roll over, and do it all over again. So, that's a lot of what is potentially going on right there. But with inflation, still running hot, with the jobs market still running hot, with all of the indicators that, and gas up, food up, everything up, the Fed still has a long way to go in the inflation fight. So we can't call it bull market yet. We can call, maybe a macro bottom in for the markets, the October lows, once those get tested and hold, if we get down to that level. Same thing with Bitcoin. If those levels hold, then all the markets can continue to consolidate, put a base in. Because again, there's a lot of capital out there. Retail has not capitulated at scale in the markets or in Bitcoin. So a lot of people held on. The markets did not, get enough people panicked to really roll over and go to new lower levels. And that's kind of what you need for, a big bear market cycle to wind itself up and to put in that broader base. So, a lot of people are calling for the bottom of the markets, calling for a new bull market, things like that. And, I don't see bull market conditions right now, but I do see the potential for the bottom structures to be forming and some of these lows to hold with the amount of capital that's out there going into the markets. And, with where we are right now, without a severe recession happening or on the forefront, but just, higher inflation is the only issue, and the Fed kind of tightening into that. I think markets can kind of hold up from here. If something breaks, credit markets freeze up, banks start failing, the real estate somehow goes into distress. Again, the real estate market's really healthy, not going to really cause, an event like it did in 2008 and 9. then markets could continue to kind of range in these areas, keep that base and get ready for the next run once inflation gets back under control and the Fed can stop tightening. But there is no pivot coming. The Fed is not stopping. In fact, they might have to accelerate. So as we get into the days and weeks ahead of the Fed meeting, next CPI report and all that, we'll get a little bit more color in terms of what the Fed's thinking and what they're going to do. And they will telegraph what they're going to do. So these are the things I'm looking at. I'll see you in the next video.